So welcome back, everybody, to another webinar hosted from Princeton, available for everyone and worldwide. We are very happy to have Bob Hall with us. Hi, Bob.
Hi, happy to be here.
Yes, it's good to have you with us. Bob will talk about the natural behavior of unemployment. So we will learn a lot about the unemployment in the United States in particular over the last 50, 60, 70 years and or so. So let me start as usual with the poll results. So we asked you what your answers for Bob's questions were. So Bob asks the following questions. So when inflation is steady, neither rising nor falling over time, is it A, the unemployment rate is above the natural rate, at its natural rate, or below its natural rate? And actually 15% or 11% it's above the natural rate, 84% say it's at the natural rate, and 4% think it's below the natural rate. So the huge majority said at 84% that it's at the natural rate. The second question was about whether the natural rate of unemployment is constant over time, at around about 5%, has declined over time to 3.5%, or behaves according to stable principle, rising sharply in crisis and slowly declining afterwards. And 14% said A, 37% said B, and 49% said C. And the third question was the high unemployment rate early in the pandemic, especially March and April and May. What is the answer for that? Is it completely departed from historical behavior? So inflation remains stable at close to 2%. So it's really departed that we have a close 2%. Was it consistent with historical behavior? If one corrects for temporary job losses, but you don't break the worker firm links. And C, the subsequent decline was much faster, will be much faster than following other crises. And here you could actually choose multiple choice, not only one answer. And 37% chose A, 44% chose B, and 44% chose C. And Bob will reveal the truth, what the answers for these questions are during his presentation. But before we go to Bob, I would like to make some few introductory remarks and put this in the context also to previous webinars we had in this webinar series. So first thing, you know, when we had Eric Hurst in June this year, we were talking about different unemployment rates, in particular, if you look in the United States. So in the United States, we had this huge spike, unprecedented spikes, and now it subsequently came down. So there was a huge spike. But if you, in contrast to Europe, you didn't have this spike at all. So in Europe, the spike was tiny. So you had this decline after the global financial crisis of unemployment, and then you had a little going up. And the argument was at that time, that's essentially very much because you had a different policy regime. So while in the United States, mostly the job worker matches, or workers were asked to go home in order to get some unemployment benefits, and the unemployment rate went up, but there was still, the matches were still maintained, and they were told if things improve, you can come back. At least there was some survey evidence that many of them hoped they would go back to the old employer. While in Europe, you had a very generous Kurzarbeit arrangement where essentially you can stay with the firm and the firm gets subsidies in order to pay on some to the workers, continue paying wages. And in the US, of course, you also have some of that, but not to the same extent. This PPP program and other programs try to copy this, but by much larger, smaller extent. So the numbers are very distorted in a sense, and I think Bob will allude to this as well. So that's one thing. The other thing is I would like to contrast a little bit the US and Europe. And one thing which is really striking, or was striking to me for a long time, is the labor participation rate after the global financial crisis. It came down significantly in the United States, while in Europe it did not. Okay, and again, that's probably also some people who gave up in the United States to search for jobs, and the labor participation rate came down because the unemployment benefits are less generous. And while in Europe, in order to get the unemployment benefits, you have to be searching in the labor market. And that's why the labor participation rate actually went up rather than going down. So very, very different behaviors from the data across the two continents. Another thing, when we look a little bit in a longer horizon, I would like to highlight some phenomena in Germany when you look at the unemployment rate in Germany across the decades, so after the Second World War, you had this German economic miracle, and then you had full employment in the 1960s, then you had some recession, late 60s, and then you had the first and the second oil price crisis, and then you had further recession. So whenever there was a recession, unemployment was shooting up and very sharply. And there was this phenomenon that actually whenever there's unemployment shooting up, it slowly comes back down, but it never comes down at the same level. So there was this rising socle or rising base unemployment, it was called. So after each recession and after each boom, essentially comes down, but it never comes down to the previous level. So there was this worry for many decades that you had this low unemployment rate after a boom phase. But next time it is higher and it's higher and it's higher. It only changed when in 2005 there was this huge labor market reforms. Now it's different. So now you had the global financial crisis had a little blip here, but you had essentially unemployment rates steadily going down rather than rising. But for many, many decades, the minimum was actually after a boom phase, the minimum of the unemployment rate was actually going up and up and up. And perhaps we can allude to this later as well when Bob outlines his perspective for the United States, just to contrast it with other countries as well. So what I've plotted here the unemployment rate for the US, because Bob will actually talk for a much longer perspective, so after the Second World War, I guess, and I've also plotted the NAIRO as it's estimated by the CBO. And so the question is, how do you estimate the NAIRO, the non-accelerating inflation rate, unemployment rate? So how is this estimated? And what's interesting is that, of course, there's the NAIRO, there's the U star, which is the natural unemployment rate, and there's also the R star, which is a much older concept going back to the Austrians, where investments and savings are balanced, or Wicksell worked a lot with R star. In the new Keynesian framework, it's essentially the interest rate, the equilibrium interest rate at which, if the financial or the price stickiness frictions are not present, that would be the interest rate which would prevail. And the U star, the natural unemployment rate, is in the corresponding unemployment rate in a hypothetical economy if there are no, I shouldn't say financial frictions, and no price stickiness frictions. So prices are flexible in a flexible price economy. And you see that at least the NAIRO from the CBO estimate is coming down according to the CBO. I don't know how they estimate this. I tried to look it up. I would like to learn more about that. But of course, it could be to some extent that the labor matches are much more efficient these days. So there's more technology. It's easy to find labor matches than in the olden days because of new technologies. That's why this is going down here. So you might want to estimate this with a labor search model. I think there's a lot of interesting work to be done, like Davis Haltewinger data approach, Rob Scheimer approach, and so forth, where you can actually back this out. But I think what I find interesting is where there are two episodes where the Fed was actually departing from the NAIRO perspective. You see this in the Greenspan years, where you have essentially a decline in the unemployment rate well below the NAIRO, and the Fed was not hiking the interest rates. And that actually led to a much more decline in the unemployment rate. And it's a lot of inclusive approach. So I call it this Fed's inclusion drive. So they were really trying to bring more workers into the workforce. And that's probably the best inclusion we can have in order to build for the weaker groups in societies, that they can also be part of the labor force. And you saw this again later on, before the COVID crisis, what I call it the Yellen and the Powell inclusion drive. So you had two inclusion drive. And most recently, if you look at the new Fed policy, they essentially gave up on the NAIRO altogether. So they moved away from a NAIRO framework, where they go, whenever the unemployment rate goes below the NAIRO, you have to hike interest rates because inflation dangers are looming around. And you don't see this anymore. The language has changed significantly. And I would like to know how Bob's framework, a new way of thinking about unemployment, is fitting into this picture. So with this, I would like to pass on the floor to Bob. Bob Hall is an expert in macro in many, many dimensions. And most recently, he focuses on unemployment. And we're very curious to learn your perspective. Thanks a lot again for being with us. And the floor is yours. And perhaps you start sharing your slides, and then we can go from there.
Okay, well, thank you very much for having me. This event has become firmly established in the new ways of promulgating research. Okay, so let me go back to the beginning. As Markus said, this is the title of this paper is The Natural Behavior of Unemployment. That's a play on the notion of the natural rate of unemployment. And the basic thrust of all this is that we should be talking about a variable natural rate rather than one that's very unresponsive and basically a constant. So this work is joint with Mariana Kudliak. It's part of a bigger research project, which will be presented to the National Bureau's macro annual conference in April. Mariana is an officer of the San Francisco Fed, so I have to read the disclaimer. The opinions expressed are those of the authors, do not reflect those of the Federal Reserve Bank of San Francisco, the Federal Reserve System, or, this refers to me, the National Bureau of Economic Research. I also want to, even though it's in smaller print, call attention to our thanks for the Dupro's team and Professor Perlin for sharing computer code, which has been absolutely essential to this project. Okay. All right, so this is the most famous sentence.
If you can have a low-tech solution, is just talk louder,
what?
Because the sound today is not working so well. I don't know why. If you could talk more loudly as a low-tech solution to the sound.
Wait, there was a blip in the
sound. Is not working so well.
Oh, that's terrible, because when I got this, when I got new equipment to try to solve that problem, it solved it perfectly. I've never, since I got this iMac, I haven't had this problem at all. But I'll do what I can. Okay, so this is the most famous sentence in modern macroeconomics, but it's a puzzling sentence. It was Friedman's attempt to create a framework for thinking about essentially Phillips curve issues, but from the start wanted to give some meaning to the natural rate of unemployment. What this doesn't say, but what has happened as time has gone on, is that there's a distinction between the nominal rigidities of the economy and the things that are listed here, and that this has led to one definition, which I think is probably the best definition, that if you have a general equilibrium macro model, then if you can turn off the nominal rigidities, set the Calvo parameter to immediate adjustment of prices, then the unemployment rate that comes out of that model is the natural rate. And this line of research supports that proposition. One thing Markus likes to talk about the NAIRU or the NAIRU, we take it to be a synonym for the natural rate, so we won't make any distinction. I don't know whether modern people make much of a distinction, but we don't make any distinction. Now, it's very important to understand that this is not yet another general equilibrium model, and it's not a study of empirical Phillips curves. It's a very close study of one time series, which is the unemployment rate of the US. And the US, as Markus just pointed out, is very different from continental European countries. It's more similar to English-speaking countries, but here it's studied as a unique phenomenon. And when it comes back to model building, we believe that macro models should be capable, should be judged by whether they can generate paths of unemployment with the properties that we identify in this research. Okay, so this empirical work is purely descriptive. It finds a parsimonious statistical description of the observed evolution of unemployment. That's what we're talking about. That sounds kind of boring, but actually the result of this is, I thought, and most people I think have found quite striking. So most of what I talk about today is going to be finding this parsimonious description and describing it. But after we do that, we'll come back to the topic of how you would go from the information about the observed behavior of unemployment and inferring the path of the natural rate, which presumably differs from observed unemployment, although we come close to suggesting that maybe the differences aren't very big, but that's another story. Okay, so what do we get? Here's the basic answer that we come to, and Markus already mentioned this. There's an occasional sharp upward movements during economic crises in which unemployment jumps from whatever it was before up to something alarmingly higher in the case of the Great Recession, just touching 10%. Even higher if you take the full measure of unemployment recently in April. But we'll come back to that. At the very end, I'll say a little bit of what's forward-looking. Basically, this is a backward-looking exercise. We're looking through February of this year, what the normal movements of unemployment were through February of this year. We're also very cognizant. We have another paper which is available as a National Bureau working paper that's forward-looking, forward from February, that is, looks at what happens in the pandemic, and that's a whole separate paper. So I'll just say a little bit about that at the end. But it does fit. The two things do fit together. All right. So occasionally there's a spike. Unemployment moves up quite rapidly, typically, in that spike, especially recently. At all other times, unemployment has an inexorable downward glide path at a low but reliable proportional rate. This is the central finding. It's no surprise. The first finding, of course, is no surprise. We all know that. But the second, there's been a general tendency not to pay too much attention to what unemployment does relative to what GDP does. But what unemployment does is just so striking that there's a glide path. It's not constant. It's a systematic, reliable glide path down at a low proportional rate, down to a very low level. And twice in recent times, unemployment has reached the mid 3% range, including through February of this year. And that all it requires, given this setup, is that there be a long enough time between crises. So if we have 10-year spacing of crises, we're going to have repeated instances of 3.5% unemployment. Okay, so here's the paper in a single slide. This shows unemployment in the cyclical recoveries of 10 recessions, starting at the very beginning of the modern collection of unemployment data, starting in 1948. And you can immediately see, especially recently, but actually in all these, exactly what I was saying before, which is that they start at a high level. Some crisis has occurred, which results in log unemployment getting to the 10%, or the unemployment getting the 10% level, which in our metric, which is in logs, is above 2. And then if nothing more happens, gradually there's a rebuilding in the labor market, and pretty reliably, with occasional small hiccups. And the hiccups have gotten smaller over time. And the consistency of the downward slope has gotten higher and higher, as you'll see from the statistics. And you can see just by eyeballing it here. So this is the one slide version. This is the slide that I showed at a meeting of the CBO advisors recently that Markus also attended, and it was a one slide presentation, just this slide, and it got Markus's attention, which I'm very happy about. Okay, so of course there's a big literature on the dynamics of unemployment, and in particular, there's a very good paper by Dupras, Nakamura, and Steinson that goes over, surveys the earlier literature on the dynamics of unemployment. The asymmetry that is so obvious in the data is well known. It's well known that unemployment rises like a rocket and declines like a feather. In that respect, it's like fuel prices, where a similar pattern of behavior has been documented. Okay, so there's a big earlier literature on that subject. That's not our contribution. Our contribution is to demonstrate the stability of the recovery speed of unemployment. In all the recessions I can remember, but especially recently, there's always been a remark that this time unemployment is taking longer than ever. We have a jobless recovery. But that's just false, as you can see from the data. In fact, recoveries are extremely uniform. There's not been any slowing down. There's been a complete uniformity since 1960 in the rate of recovery. Okay, so from this, we discuss at the end, inferring the natural rate from the observed behavior of unemployment. But let's be clear, we're not saying that this is the natural rate. We're not saying that observed unemployment tracks the natural rate. That's up for grabs. But we do believe that models ought to know that this is the way unemployment works, and it's not vibrations around a constant rate. It's a very systematic tendency to decline slowly when nothing happens, and to rise rapidly when there's a crisis. Okay, so there's been a very substantial literature here. These are papers that have focused on measuring the natural rate. So that's another very active literature that we're in some sense contributing to, but in a rather different way. All right, so this is mostly a measurement exercise. It's a descriptive measurement exercise, but there are issues to begin with about what the fans want in terms of, first of all, what measure. So a lot of work on the business cycle thinks of output as the central metric of the business cycle. Others, like me, have pushed in the direction of unemployment. The National Bureau's highly respected chronology actually uses a concept of a latent concept called economic activity, which is defined by that committee, which I chair, by examining a variety of indicators. So that's another way, and that's a respected way. There is no critique in our work. We're saying we're picking unemployment for a good reason, but that doesn't mean there's anything wrong with the latent approach. So the other factor is, do we need to use a bandpass filter to remove non-cyclical, slower moving trend? And our answer to that question is no, because we choose unemployment, and unemployment is an extremely econometrically stationary measure of the business cycle. It has absolutely no trend from beginning to end. It started around vibrating in the 3 to 5% range when it was first measured, and that's where it's been recently, until, of course, the explosion from the virus. All right, so our answer to these questions is, and this is very much influenced by an important paper by Romer and Romer, arguing exactly the same point in the context of their ideas about what the National Bureaus Committee is doing. But we find that persuasive that the indicator of the business cycle that we're interested in is unemployment. And unemployment is relatively little affected by forces other than the business cycle. It's the cycle, it's the measure of choice if you're interested in measuring the volume of underused resources. And as Markus pointed out in his introduction, in the US, the institutions result in people retaining jobs, but not going to work. And that shows up as unemployment, one category of unemployment. So that makes unemployment a highly volatile and reliable measure of the business cycle. Okay, so now, we define a general class of statistical models. So we take some transformation, it turns out to be the log in terms of describing the data most accurately. And as the business cycle statistical literature has emphasized for years, there's nothing new here. There's a trend on the right-hand side of xt, which is the trend, and then epsilon t, which is a unsystematic random term that you can see in the plot. Those hiccups that I mentioned in particular, but in almost every month, there's a little change that is probably resulting from, for example, sampling variation in the survey. And of course, we take epsilon t to be uncorrelated with xt. That's the basic identifying assumption. So this is a very simple statistical model. Of course, now we have to say more about xt. Okay, I already mentioned that we, as the monotonic transformation is log, and that's just a choice of what works best. That implies that the constancy is the constant proportional decline in log points of unemployment. So it implies that as on the glide path, as unemployment actually falls, the annual declines in unemployment in a recovery decline in terms of percentage points. It starts maybe around 1 percentage point per year, and then it declines to just a fraction of a percentage point per year as you get closer to the bottom, which seems to be somewhere around 3.5% unemployment. Okay, so we adopt two approaches which are already well developed in this literature. One is a chronology-based approach. So find turning points in the data, and then the turning points identify xt, changes in the slope, in fact, the sign of the slope, so that xt is rising during contractions and declining during expansions or recoveries. So one is a chronology-based approach, and the other is Hamilton's 1989 Markov regime switching model, which is very deeply embedded in this literature and a very successful, as we document here, a very successful way to think about. The regime switching model just loves to pick out the regimes that correspond to the chronology. There's a nice correspondence between the two, so they support each other. They're not really competing, but they're complements.
So Bob, can I just come back to the measurement of the unemployment rate? There are different unemployment rate statistics, and which one do you pick? And does it make a difference? And do you seasonally adjust? Do you use the seasonally adjust unemployment rate? Or does it make a difference for your analysis?
I've done work. So I have a paper in the AEJ macro that looks at, that dissects job finding and therefore unemployment in detailed categories, and shows that they're all driven by the same factor, which in the DMP literature is called tightness. So we have many different measures, demographic measures. We can look at both sides of the labor market by looking at, for example, the duration of vacancies, which is another cyclical, and all those, the correlation of all those measures is extremely high. They're all driven by a single factor, tightness. The more you work with the data here, the more you find that the DMP model is just such a good description of how the labor market works. It's just remarkable. Certainly deserving of the Nobel Prize that it won. But I think a lot of people just don't grasp how important it is that everything, or how true it is that you can infer almost any labor market variable on both sides, from the JOLTS data on the employer side and from the CPS on the worker side, and they all move together fantastically closely, just amazing. Okay, so let's talk about the chronology approach. So the chronology approach looks for turning points in the actual data and then infers the slope of the systematic component by interpolating between the turning points. And then the noise epsilon t is a residual from that process. So that's totally straightforward. And we want to make the systematic tran component xt a smooth function of t. So this interpolation, as usual for interpolation, we usually like to use a smooth function. And it turns out, as I pointed out, that once you use the log transformation, then a straight line of interpolation works extremely well, fantastic. So what that means is that in terms of the descriptive vocabulary of this kind of work, that the trend component is a linear spline. It's the interpolation between points, but using a straight line, linear. Now, lots of people use a cubic spline for this kind of purpose, but there's no need to do that. If you measure a higher order, it's easy to fit a higher order scheme, but the coefficients you get are extremely small. They are, by the way, significant, but they're extremely small. Okay, so what do we do then in terms of econometrics? We have just this very simple model in which we take U0 as the unemployment rate right after the economy is taken a hit. So U0 is a high number. UT is U capital T is a point sometime later at the trough, or I want to be careful about that, at the low value, like 3.5% recently, that occurs at the very end of expansion, recovery. So the key parameter is beta. That's the slope of the recovery. And people don't like to talk about negative numbers, so we put a negative sign in front of it to make it a positive number. And then it's the decline rate. And then this has residuals. It's got a whole string of residuals, but since we're just estimating what's basically a change, all the residuals disappear except the first one and the last one. That's important in understanding the sampling properties of the estimate of beta. Okay, and we like to state it as an annual rate, so we put a 12 in front of it. So this is real simple econometrics. And so we use the natural estimator. And this is also the regression. If you said, okay, why don't we just run a regression? That's fine. You can set this up as a regression. You'll get exactly the same number. There's no conflict. But you really only need to look at the beginning and the end. So we like to interpret this as interpolation, even though you could also just set it up as a regression. Okay, then there's an issue of the sampling distribution. In particular, there's an issue of the sampling distribution because the location of this estimator takes as given some measures of the location of the turning points, but that's somewhat up for grabs. So the sampling distribution has to consider that source of variability. So we use a bootstrap type procedure where we resample the epsilons. It's not a full bootstrap. If you're familiar with bootstrapping time series problems, you can't, because bootstrap fundamentally requires independence of the resampled numbers. It's not a full bootstrap, but I think it's highly indicative of the sampling properties. Okay, so we're going to talk about three chronologies. One is the NBER turning points in economic activity, which are pretty close, but not as close as we think we can do better in terms of finding a chronology. There's an algorithm that Dupraz, Nakamura, and Steinson have developed, which they were kind enough to send me the code for at a very early stage in their research. And that we've really asked a lot for that, and it works extremely well. We run 10,000 replications in the bootstrap, and in all 10,000 cases, you get a reasonable answer out of this piece of software. It's just remarkably bulletproof. And finally, there's a chronology that we've put together. The DNS chronology finder tends to pick earlier dates than fit our way of thinking, because they're not actually at the end of the expansion, the recovery. So we put together our own chronology, but it turns out to be very similar to DNS, and the results from it, as you'll see, are pretty similar. Okay, so here are the results for the chronology base. So what we're estimating here is the annual log points of unemployment decline that have systematically occurred in two samples. You can see the reason for choosing two samples, because the first three recoveries went faster and were more ragged than the remaining seven. So there's a clear structural break around after 1959. And you can see that, for example, the standard errors go way down if you exclude the first three recoveries. But we get, and the NBER tends to give lower numbers, and that's because we think that it's not doing as good a job as you can do in getting the actual chronology of unemployment itself, because it's not chasing unemployment, it's chasing a more general concept. So this is it's not an adverse reflection on the NBER. And of course, as you could see in the pictures, also the recovery rates are somewhat smaller. They're about 10 or 11 log points as opposed to 13, as you can see from these numbers. We also look at the standard deviation of the recovery rates across recoveries. One of the points we're making is that all these recoveries occur at the same rate. So, well, how do we measure that? We can measure the standard deviation, and then we can bootstrap the standard error of that. And you can see, especially after 1959, then you get very small standard deviations and reasonably compact, reasonably small standard errors. But the standard deviation, obviously, there's no evidence that there's variation across the recoveries. So this is just the numerical backup for what we believe you can see immediately from that picture. Here's the coefficients. You can see the evidence for a structural break in around 1960. And then you can also see the extreme extremely tight distribution of these. Okay, so here's another another picture that I think is very indicative of the fact that we've captured what's really going on, and that just shows the unemployment rate itself in red, and the interpolation along straight lines, and in particular in the last 3 cycles, the lines just lie exactly on top of each other. The residuals are really small. And that's something to think about. So that we believe we really captured an important feature. Notice that some of the things we say about the consistency of recoveries also apply to the consistency of contractions, but we believe that the contractions, the spikes in unemployment, come from a wide variety of sources, some monetary, some financial in particular. So we're not arguing we're accepting a heterogeneity of what causes unemployment to rise. Then we believe that a very common process, and our macroannual paper will go into this in great detail, the process that the economy gradually puts itself back together and the unemployment rate gradually declines at a pretty systematic log points per year basis. Okay, well then
can I ask a quick question about this figure? So the one thing which is striking, when you look at the wiggles in the glide path, often the wiggles happen when there's on the contraction side, there's a wiggle as well. So can you interpret this as an overshooting, then they come back? And then if I look, for example, in 1980, the Volcker contraction, and when it comes back down.
Yeah, well, first of all, 1980 is interesting because the National Bureau, under my leadership, that was the first recession that the committee that Martin Feldstein created when he took the National Bureau over in 1978. We had to wait 2 years, but the committee was created sooner, then swung into action. And so if you did this on the National Bureau basis, you'd see actually another small, so that's something that you'd want to think about in the case of 1980. The 1980 recession was a very odd thing. It was a very good example of how heterogeneous the sources of recessions are. It was almost completely caused by the Fed's unwise imposition of credit controls. Otherwise, I'm not sure. I'd have to. This project is really focused on the recoveries and has just taken a kind of casual view about the contractions. So we don't really have an answer to your question, Marcus, but it's a good one.
For me, it's only striking that if you look at the recovery after the 1980s, there's a little bit of slowdown at 2.0, the log 2.0. And that's exactly when there's a little bit of wiggles in the contraction phase too.
Yeah.
Similarly in the next recession.
Yeah, I don't know.
I don't know what to make
of it. Anyway, I don't. There aren't similar wiggles that well, I guess here, and here.
Yeah.
Those are the only.
And the other one from 1989 to.
I think what we do is the conservative thing, which is that we treat all the wiggles as econometric residuals, and we don't try to read too much into them. Okay, then there's the Hamilton approach, which again we were able to use existing software and to validate. Both these software packages that we used got extremely strong validation from all the work that we did, of running them literally millions of times. Well, not this one, because this one actually takes a significant time to converge. Okay, so now we're wrapping the two statistical problems together and taking a probabilistic approach to the chronology. So it spits out not a chronology, but a time series probability of regime change. Basically tells the same story, although as we'll see, there you do get a somewhat smaller, instead of say if after 1959 results, where you're getting 0.10, you get 0.07, and I'll show you in the next slide that that's significant. So there's an interesting question of why there's just enough difference to suggest that there's a slightly different story if you take this probabilistic view, but fundamentally it's the same. Okay, so here's the two estimates, 0.106 and 0.070, and the difference is 0.036, and the bootstrap standard error is 0.012. So you have to live with the fact that it's not just sampling variation.
So Patrick Ono would like to know whether you have some explanation why the pre-1959 recoveries were much faster than the post-1959. Do you have an explanation for that, or are we going beyond statistics?
Not yet.
Okay.
It's on the agenda, but not. You know, it's very clear that the economy sort of flopped around. The volatility of lots of things was higher before 1960, and of course there were two that mattered a lot. There was the recovery, the tremendous transformation of the economy that occurred after World War II, and there was the Korean War, and those had much bigger effects. But no, that's we treat it as an obvious regime change, but it's interesting. You know, it's a story that starts in 1960, but it's, you know, 7 consecutive instantiations that after 1960. It's pretty impressive. Of course, it would be even more impressive if all 10 of them were the same, but you can't always win. Okay, so now let's come back to the question of.
So can I interject another question, because somebody is asking a question. Did you look a little inside the unemployment rate, where the different demographic groups were hit, women, men, and all this? Or did you not look at these finer data yet? Is it the same for women? Is it the same for the old and the young? Did the glide path, it looks the same across demographic groups?
Well, I mentioned that as a very general matter in the labor market, if you break down into the different groups reflecting the heterogeneity of participants, and if you also look at tightness measures by on the employer side, the duration of the obvious measure of tightness is the duration of a vacancy. Duration of vacancies shoots up as unemployment, or as the market tightens and unemployment falls, and that's true. If you decompose that into components, then you find like industries or occupations all move together. And if you look to all different demographic unemployment measures move together. Some groups are higher, some are lower, some of it, they have different elasticities with respect to as the common factor. And in my paper with Sam Schulhofer-Voll and the AEJ macro, all those things are done. But it's just remarkable how there's a single driving force. Now, I think it's probably a good idea in this paper to demonstrate that, say, for demographic groups. But we know what result we'll get. That with varying elasticities and different levels, unemployment moves the same way in a crisis. Everyone loses in a crisis. that everyone gains at different rates, of course, in the ensuing gradual recovery.
Okay,
so we know what the answer will be. But
is it fair to say that your finding illustrates a little bit that policy is affecting the turning points or the start or the end of a recession or a boom phase, but it's not really affecting much speeding up job market creation, job creation in the boom phase? There's not much the government can do through fiscal policy or other policy measures.
okay,
So it's pushing it too hard.
35 pages of demonstrating how true that is in their nascent macroannual paper. Yes, that's exactly right. It's extremely impressive that the process of reassembling the labor market and by putting people back to work seems to just have a life of its own. It's completely reliable. It's completely uncorrelated with policy. There's nothing we can do about it. We just have to sit back and watch unemployment gradually glide down. But there's nothing we can do about it. That's a very strong message. But that's not in the paper that I gave today. I'm just jumping ahead. Okay, so then the question arises about how this reflects on thinking about the natural rate. So the first thing is that it seems like that the notion of fixed or almost fixed natural rate is untenable given these findings. It's very, very hard, at least for us, to think of a way that we could go for so long. You know, you mentioned the Greenspan 90s and the recent 2010s, very long expansions in which this consistent behavior just went on year after year, drove the unemployment rate. Somehow the CBO, for example, Markus showed the CBO's natural rate, and it's just slightly bows upward and then declines, but it remains in the 5% range, even when in fact unemployment was 3.5%. Some of us on the advisory committee have been pressing them very hard, especially recently, to say that that's not tenable. And of course, it comes with this mystery that that wage inflation or price inflation don't explode as we gradually transit down to 3.5%. So people say, oh, the Phillips curve has become completely flat, but that's kind of silly, it seems to us. Why not entertain the possibility, which seems to stare out of the data so strongly, that what's happened is that the natural rate has declined kind of along in parallel with actual unemployment. Okay, so of course there's various ways that gets into natural rate measurement. We've been operating so far without a clear definition of what the natural rate is, and I think the most we can say is that we're most sympathetic, I think, conceptually, to the notion that you can take a model, you can remove Calvo from the model, make the price adjustment instantaneous, and solve the model again, and that will tell you the natural rate if it's a good model of unemployment. My impression is that most New Keynesian models would flunk that test because their models of unemployment are not very good. They don't have the ability to track this way, but that's a defect of the model, and the way to think about that is that the model in its observation should confirm the data that we're getting out of the actual economy. In other words, we put it differently. We're coming up, you can think of our researchers giving moments to modelers to match. And if they can't match them, then there's something wrong with the specification of unemployment. It's not grasped, doesn't include taking account of the way the labor market really works. Okay, so these issues will be expanded upon in the macro annual paper. So stay tuned for that.
So
okay,
can you imagine a new
so
Keynesian model merged with a DMP model, labor search model, and that will come closer to what you're finding? What this?
I think so. Well, yeah. I mean, we don't have to imagine that. There are quite a number of such mergers in the literature already. Now, of course, I applaud that, especially when they introduced realistic wage stickiness from alternating offer bargaining, which is a feature that they've grabbed onto enthusiastically. Okay, but we're getting outside the scope. Okay, so other general observations are that you can flip this around and say, if inflation is stable, then the unemployment rate is at its natural level. So in the period of the last 20 years of very stable inflation in the US is plugged in to what I would regard as a reasonable Phillips curve, then your out is going to pop immediately that the stability of inflation means that each observed unemployment rate isn't at near the natural rate. In other words, the natural rate is going to look a lot like the actual rate. That's just an obvious proposition, and it's amazing how strongly policymakers have resisted that obvious implication for a long time. So it's been frustrating to me that they were just not willing until quite recently to face up to this. So that's what I just said. So one idea, of course, would be to take the actual employment rate as a good approximation to the natural rate. Let's abolish Keynesian economics completely. We don't need it. But that's a radical conclusion. Okay, so the existing approaches are a long-run average of the actual unemployment rate. I've already explained that that's a non-starter. A rate backed out of the Phillips curve. That's going to depend on identifying the Phillips curve, which has proven to be very difficult. There's a very good 2010 paper by Stock and Watson that really dissects what you get from the data if you sort of take an honest econometric view, and you don't get anything like a Phillips curve. It's a very interesting paper, insufficiently appreciated. And finally, the approach that obviously makes sense is that you define the natural rate by a well-defined alteration in a macro model, general equilibrium model. And then our contribution is, as I mentioned before, to provide moments that such a model in its full range, in its full form, can explain why unemployment moves the way it does. And that, I think, we're only beginning to get started on that, but it's a promising area of research. Okay, so unless I've run over too badly in terms of time, I think I've said all those. I think I can skip over this because I want to. Okay, so of course there's an obvious policy implication from this general view, and that is that the Fed's new policy of not resisting a downward glide in unemployment during periods of calm is completely consistent with our conclusions. This is something that actually I've been arguing. Greenspan convened a meeting of experts, including me, at the board when the unemployment rate began to drop below in the early 90s, around 94. And some of us, a lonely group, said, maybe you shouldn't worry. Maybe maybe the natural rate is already, 4% and headed down to 3.5%. And Greenspan had the guts to do it, and it worked fine. But then more recently, I think we had more of a problem. The Fed was so devoted to their Phillips curve analysis that they started putting their foot on the brake. They almost talked like they were unemployment controllers. There was a danger of unemployment going too low, and it was their job to put a foot on the brake, even though there was nothing in inflation yet. But they were so sure that inflation would come, because they were so sure that the natural rate was 5%, and they thought it was too dangerous to go to 4% or God forbid 3.5. And now, in retrospect, I think as Chairman Powell's remarks just recently at Jackson Hole, we finally have a Fed that sort of has gotten back to the Greenspan view, which is if it doesn't trigger inflation, don't worry about it. Just come up, agree that the natural rate is a pretty low number under certain circumstances. And the certain circumstances are following a very long period of economic calm and the absence of any crisis. Okay, so speaking of crises, let's now, okay, so I mentioned this is good, just going to get one slide from
Can I ask a quick question which came up?
Sure.
So if we can't rely on the unemployment rate going sufficiently low, what are other early warning signals if you have to hike interest rates? Can you give us an alternative, or that's for the future to figure out?
Okay.
Or depart from the Taylor, or should we modify Taylor rules somehow, or what should we do? Do you have a proposal on that?
I believe, and I've written that we should look at the consensus forecast of inflation over the next 2 or 3 years and try to peg that. And that's a pretty common view. That's not original to me. And so that requires relying and deciding who the forecasters are who get to play in this game. But and I think it would require some judgment. That is, it's not an autopilot recommendation. It's that when the question comes up, is monetary policy too tight or too loose? It's too tight if the inflation rate forecast over the next 2 or 3 years is below target, below 2%, and it's too slack if it's above 2%. So it's a way to explain that monetary policy is right on target, even though the price level is subject to random variations in the short run. The best way to smooth is to rely on forecasting. That's been my view for a long time, and I think it's still a viable view and a reasonably popular view among people who've thought about this. So the Taylor rule should be modified to be driven by this forecast rather than by lagged inflation. That would, I think, solve a lot of the problem that you're thinking about. Okay, so just quickly, so this now comes from this other paper that is available as a National Bureau working paper. And a lot of people have pointed this out. We're just trying to integrate it and give it a name, give names. It's always been the case that there's 2 kinds of unemployment in the US, and that's what we call jobless unemployment. And that's the kind of unemployment that's described by the DMP model. And it's been the dominant form of unemployment, as I'll show you in a second. But we've also known that there's recall unemployment. And I think there's a lot of, I think Markus reflected the general view of recall unemployment, which is maybe there's some people who are dreamers who think that their job's going to come back, but really that's not a realistic view, and we shouldn't take it too seriously. That's not what the numbers say. The numbers say the exact opposite. The numbers say that the great majority of workers who are in the recall unemployment category, that is, they're at home and have stated a belief that either they've been given a definite date for recall or that they've been assured that recall will occur sometime in the next 6 months. Those are classified into recall unemployment. They don't have to qualify for unemployment by actually looking for work. They're just a different category. Okay, so both these kinds of unemployment merit careful measurement because they're associated with lower aggregate work effort. So in terms of measuring resources, unused resources, they're on an equal footing, and it's appropriate to add them together as we do. On the other hand, when you're looking at dynamics, the dynamics of these two categories are just altogether night and day different. And the recall unemployment melts away very quickly, and the jobless unemployment, which is standard unemployment, is subject to this very, very extended, very low decline rates as we measured in this research. Okay, so all right, so prior to the pandemic, recall unemployment was unimportant, and then there was an explosion. I might as well go to the numbers here. Okay, so here are the historic numbers. So the blue is from temporary layoff, that is what we call recall unemployment. And then the red is the unemployment that it looks identical to what we were talking about, but it's not quite the same height. It's not, for example, here, it didn't go to 10%, but it did go to 9%. So in a crisis, in a traditional kind of crisis, not a pandemic, there's just a little bit shows in the recall unemployment, but it's mostly genuine job loss with a very slow, protracted decline recovery. Okay, so here's what's happened recently. And you can see that just an explosion in April of the temporary layoff category, and then just remarkable speed of reabsorption of these people, almost entirely by recalls actually occurring. Hidden here is a modest increase, but a meaningful increase in what we might call DMP unemployment. The people who don't have a job are engaged in the time-consuming process in terms of net changes. In this environment, the labor market is actually quite tight. I don't think I included that slide here, but I can just tell you. The labor market today, by many measures, by today I mean September, by many measures is as tight as it was back in February when everything looked so good. In particular, the duration of vacancies is still as long as it was in February. Job finding rates, let's see, I didn't include those, but anyway, if you can download this paper from Mariana's website or from the National Bureau, and it'll show that in terms of sort of a DMP type analysis, and in particular, notice that it seems clear that these blue bars are going to gradually go down to nothing. And then the real question is what happens to the red bars. So far, red bar development has looked pretty good. And it's even further supported by these numbers that show tightness. Job finding rates are as high as they've ever been. It's as hard for employers to find new workers as it's ever been. So the labor market in this and the blue bars are really going down rapidly. So who knows? We don't do forecasting, but I think it's very important. the financial press has just tried everywhere they can to make the situation look completely hopeless. And every new development, there's always some derivative that's turned negative. The growth of the growth rate isn't as high as it used to be, so it's a catastrophe. But what you actually see here is kind of interesting and suggests that unless barring some factor that would create another wave of layoffs, which of course is possible. But you can see what happened here was that there was a tremendous spike of layoffs that are gradually quite rapidly. But just contrast this rate of decline of this kind of unemployment with the extremely slow rate documented for the red kind of unemployment. Okay, let me stop there. Very welcome.
Thanks a lot, Bob. These are fascinating slides and fascinating findings. Jim Stock actually has a question. Let me read it to you. And the constant log decline model is an implication of U during recoveries being well described by an AR1 with an annual coefficient of about 0.88. So what's your reaction to that? So is it?
Well, first of all, I would never dispute Jim Stock on an econometrics question. I'm not sure I see the significance. That's just another way of saying what's happening. But,
so you could run that. You could run an AR1 essentially too and inject that.
Oh, okay. Yes. Yeah. Okay. One of the things I have worked out, it's not in the slides, but rewriting it as an econometric, as just a time series equation is perfectly, yes. And then it would give a number like that. I'm not sure it's just another way of describing the same reality, if I understand correctly.
Yes. So some other questions. So what I'm puzzling with is it seems like you have a one state variable economy, and what's really important for policy levels is you cannot affect the recovery much, at least the unemployment gliding path much with policy. So what you have to focus on as a politician or policymaker is to really make sure that the spikes are not too large. So you manage the crisis. Is this a fair conclusion, or is it?
Oh, of course, sure. Yeah, if you say what's the policy that would improve labor market performance, it would be eliminate the sources of instability. The Great Recession was just very clearly irresponsible supervision of major financial institutions, creating an extremely unstable financial system, which collapsed in a heap as a result of something that shouldn't have had any effect at all, which was a decline in real estate prices. COVID obviously is a harder question.
So essentially, monetary policy should be much more focused on stability considerations rather than deviations of the unemployment rate from the NIRU.
Absolutely, absolutely. I couldn't agree more, and I've been saying that. If we wouldn't be struggling with the consequences of the slow but steady recovery rate if we didn't have to recover from the effect of some shock. But I mean, the Great Recession is just so obviously a shock that shouldn't have happened. But other shocks, I'm not sure. I think you have to look at it shock by shock. And I think it's very much up in the air whether what kind of policy in the USA could have gotten a better result than we had from the virus. We're kind of a disorganized economy. And at least until the last few days, organized economies like Germany, it looks so much better. But now Germany is suddenly having to take new steps. So I think it's much too early to pronounce as a macroeconomist on the pandemic issue. But I completely agree that if we could just stabilize these shocks are enormously expensive. They knock things apart, and then it's a very laborious process to reassemble employment. and if the shocks are avoidable, let's do everything we can to avoid them.
So let me ask you a different question about, so it could be that the log unemployment rate, the gliding path is so linear because of a given policy. So it's just an endogenous outcome in a sense that the policy is reacting in a particular way that we get this gliding path. And if we had a different policy, we might not get the gliding path, but we just observe the same policies all over the place all the time. And that leads to this linear phenomenon. What would you say to that?
Well,
it's only the equilibrium outcome we're observing for a given policy, but if we were to do a crazy policy or some other policy, we would not observe this gliding paths.
That's the major topic in the macro annual paper. Mm-hmm. It's of which there is a National Bureau working paper that's a very early version of the ideas. It displays the incredible heterogeneity of policy during recoveries. Now you could say, well, wait a minute, that's because policy is being successfully instituted. It's dealing aggressively with things that we don't see because policy is so good. All you see is you see a stable movement of the economy as a result of aggressive use of policy. I think that's your idea that maybe policy is very successful. I think it strains credulity, but I'm not. I don't think we're going to be able to convince everybody by this paper, but it is a new way of looking at.
So another question which comes from Patrick Honohon again. There are two types of recessions. Some recessions are exogenous shocks from outside, like the COVID shock or oil price shocks, and then there are some recessions which are the buildup of imbalances which have to be corrected later on. Do you have any message whether we should distinguish with these two types of recessions and of course in the recovery after these recessions? So typically the argument is the recovery is slower after you have these imbalances building up and you have to correct for them. The recovery takes longer. You would question this view, is this correct?
Certainly not at this stage. This paper makes a very clean dichotomy. It says we know that there are these big shocks from time to time that cause unemployment to spike. We know they're heterogeneous in sources, as you were saying. We don't say anything more. We say we're only interested in the fact that it's very clear that the unemployment rate is a slow-moving state variable once it's been elevated. So we don't say anything about the elevation process. This is entirely research. We just pretend we don't say anything about the cause of we treat each recovery as starting with a high level of the state variable, unemployment, and then follow its law of motion from that point on. But we don't take a stand. But I personally would agree with what you're saying, that there's heterogeneity. I mean, that's all we say. All we say is that there's a lot of different reasons that the economy falls apart. Putting it back together involves pretty much the same process.
So we're running really late, so that was interesting. So I would like to close with one question, and then typically we end with a positive note. If you have a positive note relating to your paper, what some positive conclusions we can draw, you can throw it in. But one question which came from the audience as well. So elements like the gig economy, does this have any, so, the unemployment might be very different because some workers now much in the gig economy, or do you think it's too small to have a big impact on that? And then if you were to split up the US in states, and you would analyze each state separately, would you find the gliding path too? It would be interesting to see whether at the regional level,
yes,
that's also the case.
Well, I'm conflicted on the gig economy because my middle son is the chief economist of Uber.
Oh,
I can't comment on that. I'm conflicted. But I think in general the gig economy, well, first of all, we've had a gig economy for years. I mean, there's a lot of areas of work that are just traditionally done in a gig way, you know, like, and lots of journalism is done that way. It's all over. It only amounts to, you know, maybe around 10% of labor input. So it's not, even though it's widespread, it's not that big a deal. In terms of a positive thing, I guess the positive thing, I think, is in this picture that's still showing, if it's still showing, that the kind of unemployment that doesn't look like it's going to melt away very fast, the red bars, is not very high as of the most recent reading. Now, we'll get a new reading a week from tomorrow on Jobs Day. And if it turns out that the red number is 8%, that's bad. And if it's more like it's the trend it's been on, if it goes up just a bit more, that would be good. That would be your favorable answer, because it's not the end of the world. If the blue bars disappear and we're left with 5% unemployment where we used to have 3%, that's not the end of the world. And we know that that's going to melt away once the virus completely disappears. We have every reason, I think, to believe that the labor market will work the way it has historically, which is to correct the red bars back down at about 10 log points per year. So that's my positive statement.
We're still in a phase to keep the red bars from not spiking too much by having the CARES Act and other initiatives too. Yes. That's where policy can make a big difference.
Yes, agreed.
Yes. Thanks a lot. That was fantastic. Thanks a lot for presenting these insights to us. I think this gives a lot to chew on, and that's, I think, what good research is about. I guess a lot of people will think about it, and as you said, will try to match your finding in some and calibrate their papers to match your findings. So that's a very insightful and important research. Very much appreciated. Hope to see you soon again. Probably latest next CBO meeting or somewhere else.
Absolutely. Thank you for having me.
Thank you. Thanks.